Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we've been talking about some of the volatility we're seeing in the market, of course, this part of the year. And of course, last year was very volatile as well. I think the S&P ended up maybe a little over 1% was the return for the year. When you look again from 2000 forward, which I purposely do that, by the way. You'll hear advisors, all right, that are trying to sell you on the market as an example, that are saying, you know, if you look at the last 30 years or 40 years or 80 years, you know, the market is average 8 to 10% depending on the period you select. Okay? Now, what's the problem with that? All right? 30, 40, 80 years ago, all right, or over that period, what we're looking at is what's going to happen in the next 10 years. Okay, so if I look at more recent history from this century, let's say, from 2000 on, then I see in that first 16 years, from 2000 through 2015, an average return of about 3.8%. And then when I look at Dow Bar, which looks at what actual investors get, who are investing in equity mutual funds and bond mutual funds, we see that that number is about 1/3 to 1/2. In other words, they're only getting somewhere in the 1 to 2% range as an average return over the same period. Okay, and that's the average. That means that half the people got less than that, didn't they? So how are you doing? Do you understand about asset allocation being the biggest determinant of what you're going to get for a return in the stock market? And why is this important? Well, let me ask you, there's all this volatility, right? And there's all these concerns about the economy. You know, we talk about wage stagnation, right? The wages haven't gone up in decades. That we're stuck at the same medium income range around $50,000 a year. So we look at all the volatility. We look at the fact that our government continues to run deficits. In other words, they're spending more than they're taxing us, and they're running up debt in the process. Sometime that's got to get paid. Does anybody think they're paying too much in taxes? And yet are we paying too little? It might seem that way if we're spending more than we're being taxed. Okay, so what does that mean? And historically, by the way, if you're making $50,000 a year, you're in a 50% tax bracket. You go back 20 years, you'd have been in a 28% tax bracket, double the tax bracket you are today. All right, so there's a lot of things that have to get fixed, and all this volatility. Here's an interesting question that I came across the other day. What would happen if you lost your job? Okay, so if you're working, what would happen if you lost your job? And then what would it be like if you were without a job for 30 years? Okay, and that might seem like a devastating thought, and yet now let's think of it in a different way. What is retirement, right? Yeah, for many people it's being without a job for 30 years. Do you have enough saved for that? Do you have enough in your retirement accounts? Do you know? Do you know how to make sure that you'll never run out of money? See, there are studies that show us the best ways to go about doing this. There's a science to investing, to asset allocation, to get the most return with the least amount of risk and volatility. You remember earlier when I was talking about the S&P from 2000 through 2002, it took 5 years, all right, till 2007 to recover from that bear market. And then from 2008, it took another 4 years after that to recover from that bear market. Yet if you would apply the science of investing, utilizing asset allocation, the portfolios there, okay, that utilized Dr. Fama, for instance, who won the Nobel Prize in 2013 in economics for his equity research, he's developed a model. He's done the work. And in fact, his models show a recovery of half what it took the S&P. In other words, over that same period from 2000 through 2002, you'd have recovered in less than 2 years. And even in 2008, 2 years. Less than half the time that the S&P recovered. Wouldn't that be a lot easier to live with? And yet getting the same, in fact, even better returns? Over the period I talked about when the S&P was down, or excuse me, averaged about 3.8%, right, from 2000 through 2015. Averaged 3.8%, and these portfolios average about 5%. And that's a balanced one. That's just a 50-50, very moderate portfolio. If you were more aggressive in stocks, you would have done even better. Why is all this important? We don't want to run out of money. Take a look at this next slide. This is long-term annualized return. This is the S&P 500 average versus the average equity fund investor. This is what I was talking about. Remember what I said about the average, about the S&P 500 over the period? Okay, so if you look at those green bars, that's the S&P 500, and then you look at the average equity fund investor in the red bars, and you see that the average investor, the S&P way outperformed the average investor over that period. Now let's take a look at the next slide. All right, on the next slide, if we look at, this is from Dow Bar, and we look at the average returns from Dow Bar. Okay, in that situation, okay, what do we see? We see that the average, first off, you look at the S&P 500, you can see that bar on your far right. We got the two indexes, the Barclays Aggregate Bond Index and the S&P 500 Index. And as you look at those returns, you can see that over the last 20 years, remember, the longer you go out, now we're bringing in the 90s, which were extremely good years in the stock market. So that's where those 20 and 30-year returns are pumped up somewhat. In the 10-year period, we've knocked out the bear market of 2000 through 2002, so that looks a little more attractive too, doesn't it? So if we take, that's why I use that 16-year period. I'm looking at the things from this century. I'm purposely starting with two bear markets and seeing how are we doing going forward from there. But again, if you look at these, the indexes, the returns are so much better. Now if we look to the far left, equity funds, that's the average mutual fund investor. And you can see there the average return for the average mutual fund investor ends up being somewhere, in essence, if they were in 100% stocks, somewhere around 50 to 75% of what the S&P did, but depending on the period, again, that you look at. Now, if you look at the asset allocation fund, that second one in, now that's the average investor is basically putting in half, basically 50-50 stocks and bonds, and then depending on what they've done for their, the amount of on their stocks where they've got other asset categories besides just the large companies represented. So you can see here that the average investor gets, again, about 1/3 to 1/2 of what the market actually provides. Okay, let's look at the next slide. This is showing, again, this is another kind of graph showing something very similar in terms of, now it's just putting it into dollars, saying, going back to 1972, had you invested $100,000 back then, how it would have grown. And it's showing on that bottom number, the average mutual fund would have grown to like 3 million, whereas if you had a if you look at the S&P 500, it would have got twice that return at 6 million. Okay. So why is that? Let's look at the next slide. One of the reasons with asset allocation, and this is asset class correlation. So when I talked about the science of investing, Dr. Markowitz did some work back in 1990. He won the Nobel Prize for his equity research in economics, right? And what it showed is that if you blend together certain asset categories that have a negative correlation, in other words, when one's up, the other's down, think of oil and airlines as an example, right? Then what you do is you get this, you'll get a smooth out that return, that volatility. You're going to get the desired rate of return, but without as much up and down in the process. Okay, that's the foundation, Dr. Markowitz work. Then if we look, in fact, at the next slide, which is the Markowitz Efficient Frontier. All right, this shows what that would look like when you're comparing portfolios. So on our next slide, the Markowitz Efficient Frontier, we're going to see, this is what Dr. Markowitz found, is by using these asset categories with the negative correlation. Now if you look at this chart, what it's showing on the far left is it's showing the average return, and this is looking over the last 40 years. And then if you go to on the bottom, it shows the volatility. So in other words, the farther out to the right you go, the more the volatility, the more ups and downs you would have to be able to deal with to get that return. So now we look at the S&P 500 index on that far right, standing by itself, and you can see it's got about an 18% standard deviation to get that 10% return over the last 40 years. Now if we, on the other hand, let's take a look at that balanced portfolio, the second one in from the left, the moderate portfolio, 50-50 stocks and bonds. Now we've blended together large companies and small companies. We've blended together growth companies and value companies, international and domestic companies, and put that portfolio together now. And what we see, these are all asset categories that have a negative correlation, and we're getting the same return over that period, but with half the risk, a 10% standard deviation. All right, this is why it's so important to understand this. Now let's take a look at the next slide, which will actually show you all those asset categories put together. Now this is using Dr. Fama, all right, who won again the Nobel Prize in 2013, building upon the work that Dr. Markowitz started and won the Nobel Prize for back in 1990. And he developed what's known, Dr. Fama that is, developed what is known as the three-factor model. This is how we put a portfolio together. Now let's look at the model portfolio in the next slide compared to the S&P 500 index over the last 16 years. Okay, these are the kind of things I get into in depth with clients when they come into my office, all right? I want you to understand these things. I show you the same graphs. I show you how this works. So please take a look at this, and then if you want to take advantage and come in to see me and be able to go over your specific situation of how your portfolio will blend yours into these charts as well. We can show how your portfolio, your current portfolio, would have done over the same period relative to the S&P 500 index and the model portfolios. So if I had $250,000 invested, okay, starting at the beginning of 2000, and it was in an S&P 500 index fund, it would have grown to $459,000, again about 3.8% a year is the average over that period. Now if I look at the 2000 through the balanced growth, that moderate portfolio, right, the model portfolio we're talking about, if we use those principles that we just talked about with Dr. Fama in the development of his portfolios, and that 250 would have grown to $543,000, almost $100,000 more over the same period. Okay, so it's kind of important, wouldn't you say? That's a 40% increase in your return. All right, now we're going to take a look at the next slide, and this one is on the average of all mutual funds. Excuse me. So what this is showing now, the bottom line, that 100,000 since 1972, this is showing, you can see I'm showing you long-term as well as short-term, and then I'm going to break this down into how you use it. All right, so the average mutual fund would have grown to about $1.6 million since 1972, all right, so that's again about 40 years. And over that period, or over 40 years actually, 100,000 would have grown to 1.6 million in the average. That's what the average mutual fund did. Okay, average of all mutual funds. So had I instead blended together using those the moderate portfolio I mentioned, I would have got a 6.6. I know it's hard to even imagine. 6.6 million. Okay, with a moderate portfolio. Keep in mind. That's still taking it pretty easy. As you can see on the top two lines, if I want to get aggressive in stocks, I could have gotten 11 million or even 16 million on that original 100,000 investment. Understanding asset allocation is huge when it comes to your money and not running out. All right, so let's take a look at a couple of things. If you're looking at retirement, again, it's so important to understand how asset allocation works in your portfolio. If you've got money in a 401k, do you understand how you're, allocated currently? Did you just maybe say, I'll just do the target fund? Well, again, you want to take a look, what's in the target fund? What are the mutual funds? What are the holdings? How many stocks do I have? What's the turnover ratio? What about those bonds? Do I have junk bonds? Do I have long-term bonds that are going to create problems for me? Now's the time. There's been a 7% drop in the market so far year to date. There's a potential here. We don't know what the future holds, but do you think it might go down even further? Would you like to protect yourself against those losses? We're going to get into that and more as soon as we return here on the Retirement Report.